Good morning and welcome to the Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Colin Stewart, CEO and Portfolio Manager at J.C. Clark Limited, will be joining us for the hour. In 10 minutes, Toronto Tech Week is underway. We'll chat with the co-founding partners and co-directors, Melanie Trong and Julia Konofel, about how Toronto is redefining its role on the global tech stage. And we want to hear from you this morning on First Call. Reach out with your questions on North American equities, and we'll have Colin Stewart answer as many of them as he can at the end of the show. The number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes. Our email address is firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. Bank of Montreal top profit estimates in the second quarter on robust fee revenue across capital markets and wealth management. Global markets and corporate banking were also up significantly from a year earlier. The bank increased its quarterly dividend by 4 cents per share. BMO's provisions for loan losses were lower than expected. Profit in the latest quarter at the Bank of Nova Scotia beat estimates thanks to strength in its Canadian banking division. Also, it announced an increase to its quarterly dividend, 4 cents a share. The bank says it expects to see earnings increase by double digits as it works to cut costs. And National Bank beat analyst projections in the second quarter profit and revenue. The Montreal-based lender's performance was driven by credit discipline and share buybacks. The bank also saw growth in its personal and commercial banking income. This comes after the bank closed the purchase of Canadian Western Bank in February of 2025. That is, it's also raising its quarterly dividend by 8 cents per share. And now our top line story. It's the banks. The big banks all posting their earnings so far. Their earnings beats. National Bank, Bank of Montreal, Scotiabank topping analyst expectations. Capital market strength and solid Canadian banking helped drive results, while National Bank and BMO set aside less for loan losses than forecast. Still, each lender facing pressure to boost returns, from National's retail review to BMO's U.S. focus and Scotiabank's broader turnaround. Let's break down these results with our guest for the hour, Colin Stewart, CEO and Portfolio Manager at J.C. Clark Limited. Colin, thanks as always for joining us. Go. Let's talk three of the banks. They like to do this to us, don't they? They drop them all at once.
Yeah.
Big picture for what you've seen today. How does it look for the banks?
Yeah, I mean, I think big picture is, as you just reviewed, Roger, the results all look good. I mean, Scotia, BMO, and National all beat on the headline EPS number. I think, as always, some differences from one to the other. I mean, just starting with Scotia, I think it looked like net interest margins better than expected. Maybe capital markets a little bit softer for Bank of Nova Scotia. As you had mentioned, they are sort of in the midst of a turnaround effort, trying to cut costs and focus on restructuring the international business a bit. The overall, I think one of the surprising things perhaps that I noticed in some analyst notes I reviewed this morning were that the PCLs on the Canadian side were better than expected, but the overall PCL, due to sort of higher provisions for credit losses on the international side, were maybe a little bit higher. And then the ROE, I think they're working towards a 14% target for 2027. They got up to 13.2, but still, lower than some of the other Canadian banks. So I'd say, some mixed things as always, but overall looked like the number was better, and we'll see how the market reacts to Scotia this morning.
It was Scotia was negative, but I just looked. I think it's turned. It's slightly up right now in pre-market. Let's take a look at Scotiabank right now. What was their most successful? Wealth management, capital markets. It looked like they did well there.
Sorry, on Scotia?
For Scotia,
yeah. Exactly. I think the capital markets were a little bit softer, I think, compared to BMO and National, but the net interest margin was better. And then, as I said, making some progress on their ROE target towards that 14%. I think it was 13.2 in the quarter. And then the PCLs on the Canadian side being better was I think a positive surprise as well.
It's funny you're saying they did okay, but they were like I was looking. Global wealth management was up. Revenue was up 14%. Global banking markets revenue grew 11%. Capital markets 19%. Those are
pretty solid year-over-year numbers. Absolutely.
From the positive side, anything else standing out? Just looking at some of the notes here. Their pivot in North America, the strategic pivot, is that paying off? They're targeting 90% capital allocation to North America and leaving Latin American countries?
Yeah, I think they are trying to focus more on, the North American business and grow the U.S. business, improve the Canadian business, and perhaps, reduce some of their international exposure. And that seems to be, they seem to be making some progress on that front.
All right, and on the downside, the credit losses elevated.
Yeah, a little bit elevated.
Is it concerning or no to you?
I think the often people focus more on the Canadian side, and I think with Scotia, they do have a big international business, and there have been some, perhaps some more economic weakness in some of those Latin American countries. So I think it's not totally surprising to see some, slightly higher PCLs there. But I think on the, the opposing side, seeing better PCLs on the Canadian side is a positive for Scotia.
And their ROE was below target? Anything?
Yeah, well, they're moving towards that 14% target. I mean, I think they've been running at a lower ROE than a number of the other Canadian banks. I think the number in the quarter, from what I saw, was 13.2%. So certainly making some progress. I think they've set a 14% target for 2027. So I think they're making some progress toward that target. And yeah, I mean, we'll see. As you mentioned, looked like the stock perhaps wasn't doing too much pre-market, but we'll see how the market reacts this morning.
All right, let's go to BMO now. Anything to stand up? You mentioned a couple of things. What's the biggest highlight for you?
Yeah, I think BMO across the board looked pretty strong, and the capital markets were excellent. Looks like wealth management in the U.S. business very strong as well. Maybe the Canadian business a little bit softer than some of the analysts had expected, but and then I think again on the positive side, particularly I think for all the Canadian banks, one of the focus items for the last number of quarters for analysts has been the PCL levels of the provision for credit losses, because there is some concern with just the general consumer in Canada perhaps being a bit weaker, the tariff situation with the U.S., just concerns that we could see some higher credit losses in business. So the fact that BMO's PCLs came in lower than expected, I think is a positive, and the market will presumably like that. So that I think continues to be sort of a focus for the Canadian banks right now.
All right, and then I guess bank number 6, National. Numbers look good, didn't it?
Yeah, they did. I mean, capital markets beat, wealth management beat. I think personal banking was strong for National. The only thing I saw someone mention in an email earlier that perhaps the net interest margin for National being a little bit weaker than expected. But again, the credit trends, very similar to BMO, were quite solid. And I think, National does have a more domestic franchise than a number of the other banks focused on Canada. So the fact that, again, their PCLs were lower than expected and the credit trends were pretty strong, I think will be seen as, a decent sign for the Canadian consumer. And there have been some concerns about, the mortgage market or just credit card delinquencies going up and things like that. And it doesn't seem like any of that is showing up yet in these bank numbers, right?
All right, we're going to take a break on that note there, with lots more banking news coming all through the day as well. Up next, though, AI breakthroughs to a community-driven surge in innovation. Toronto Tech Week is showcasing how the city is redefining its role on the global tech stage. We'll talk to the co-founders after the break. Toronto is doubling down on its positioning as a global innovation hub, with Toronto Tech Week bringing together founders, investors, and operators as AI reshapes the landscape. Conversations are focusing on sustainable growth, global scaling from Canada, and how founders and investors are adapting to a rapidly evolving market while working to retain top talent. For more on this, let's bring in the co-founding partners and co-directors of Toronto Tech Week, Mel Trung and Julia Konefel. Mel and Julia, thank you very much for joining us today. I imagine you guys are busy in the thick of it right now. What does this week bring to the city, and what is this city like when it comes to tech?
Yeah, Toronto Tech Week is an annual community-led series of events put on by over 600 community hosts, organizations, small and large, who are opening their doors and showcasing Canadian innovation and talent all across the city. It's a citywide takeover this week.
Yeah, great that you guys are doing this. I mean, I'm curious to hear just stuff from the investor side. Are there a lot of VC funds in town? Are there a lot of deals getting done and companies raising capital? What's that sort of environment like around this week?
Yeah, absolutely. We have investors flying in from across the globe for Toronto Tech Week, which is really exciting. We also have investors from across the country in, and there's a lot of really exciting events. There's a lot of reverse pitch competitions, actually. So if founders are looking to fundraise, they can go and learn from investors directly. And equally, investors are here looking for deal flow. There's so many incredible companies, new startups, scale ups. Like there's really something for everyone. So whether you're an early stage founder or an early stage investor, there's events and opportunities for you, but also for growth stage companies as well. So we're seeing a lot of investor interest from across the globe for this week.
I wanted to ask about that because there was just a report that came out about how different cities in the country are managing to divest away, move away from the U.S. and Toronto is one of the more successful cities. Is it being driven by tech and AI? Then you mentioned all these people coming in from around the globe. Are we succeeding in that sector, in the tech sector?
Yeah, I think, great things happen when smart people are in the same room. And so there's a real opportunity for Canadian companies to raise from, other Canadian investors at Toronto Tech Week specifically. And there's so much interest in AI right now. I'm sure you guys have been talking about it a lot. And those are a lot of the conversations that are happening at Toronto Tech Week. About 60% of events that are happening involve something about AI. And so it's obviously such a hot topic and a top of mind for investors and founders equally. And so our hope is that by bringing people together, we'll be able to, help with deal flow, help deals get done, help founders fundraise, help talent find new roles at startups within the ecosystem. So our hope is that it's fruitful for everyone that's joining.
And how is AI changing the narrative around software? I know in the public markets, that's been a big concern as far as disruption around software companies. But for a long time, software businesses had been pretty hot, and I think raising a lot of capital from VC and growth funds. I mean, are there software companies that are participating, or is that less of a focus, I presume, this year?
There's still a ton of software companies that are participating this year, like large software companies. And so, things are changing rapidly, but these companies are obviously still exist and play such an important part in our ecosystem as well. And they're changing and they're adopting, new AI practices as well. And there's still a lot of involvement, but we're also seeing some really exciting new tech and AI companies come forward that are brand new startups and that are building and raising during this week.
And is there one subsector that's kind of standing out this year where you're seeing more interest or more founders showing up for that subsector?
I mean, there's so much that's happening.
Yeah, I wouldn't say that there's one sector that's showing up more. I mean, this Toronto Tech Week is an open platform for anyone and everyone to get involved. And so we are seeing a huge diversity across all sectors, industries, even like hospitality groups also. So Toronto Tech Week really is a citywide takeover. Whether you're in tech, you're wanting to get into tech, there's so much happening. And so I think there's a pretty nice and diverse set of events happening across all industries and sectors this year.
Yeah, I will say too, there's actually been a lot of hardware tech companies. And I think that's been really interesting. I think we were all, really ready for a lot of AI events and topics. But hardware has been a big part of Toronto Tech Week this year. And so it's been really cool to see the robotics community come into play. And that's been really exciting for us to see.
And as part of the idea behind what you guys are doing with this conference to sort of just spur more innovation in the Toronto tech community, and is that like, are you seeing that sort of behind the scenes with new companies starting in Toronto and sort of a growing community of AI innovation and things like that?
Yeah, well, Toronto already has one of the most vibrant tech ecosystems in the world. And so, but what it didn't have was really a shared moment where the ecosystem could come together and showcase what's being built here. And so really, this is an opportunity for founders, investors, operators, researchers, students, global technology leaders to connect across the city and really highlight the scale of innovation happening in Canada.
And are you seeing results? And the big concern, I think, there was also an article I saw this week about the brain drain. Are you finding Canadians, specifically people from Toronto, are staying in Toronto, or is that the legitimate? They get some funding, they get some success, and they head south usually?
Yeah, well, part of the reason why Toronto Tech Week was started was actually to address the brain drain specifically amongst our younger talent pool. And so it's really important to us that we show young people what great looks like and that they can build successful and fruitful careers and companies in Canada. And so what's been really exciting for us this year is seeing so much student and university involvement this year and seeing a lot of young founders come out of that as well. We actually started a student ambassador program with university representatives from across, the major universities across Ontario. Toronto, and they've been instrumental in bringing young people into the fold. And so our hope is that by, bringing them into the same rooms as these incredible leaders, that they'll be able to understand that they can build fruitful companies here. And if they are building, then hopefully we're helping them find investment, talent, or, clients as well.
And it's such a great question because companies like Shopify and Cohere have shown that globally relevant companies can be built from Canada. So one of the most important conversations right now is how Canada continues to retain top talent while creating an environment where founders can scale ambitious companies here long term.
And are you working at all with any of the sort of the faculty of some of the leading universities here, whether it's U of T or Waterloo, to where there's been a history of tech and innovation? And are they involved in the conference, or are there programs sort of starting to focus on AI and things like that?
Yeah, we were actually both just at U of T yesterday. So Reynolds Zinn of Databricks and Mike Murchison of Ada were speaking about the future of AI and building, $100 billion company brick by brick. U of T has been instrumental in Toronto Tech Week. They've really taken it and ran with it, which has been awesome to see. But we've also seen involvement from McMaster, Waterloo, McGill, even TMU. So many universities have been involved as well in getting their young folks involved.
All right, we have to wrap it up there, but Mel and Julia, thank you very much for joining us, and all the best with the conference.
Thanks for having us.
Mel Trung and Julia Konefel are co-founding partners and co-directors of Toronto Tech Week. And let's take a quick look at see how things are shaping up on the markets. We'll start with the U.S. futures, and looks like another update. The roll continues and showing no signs really of abating right now. Everything in the green. The NASDAQ is up by 0.66, pushing in well over 30,000. The S&P 500, well over 7,500, it's up as well. And so it just continues showing no signs of letting up after record closes yesterday. Asia, let's see. They had an off day yesterday. Are they bouncing back? It's still mixed. The Nikkei is a wash, and the Hang Seng off by a point. The CSI 300 down by 0.8. Off to Europe now. And after an off day yesterday, everybody in the green there. Let's see, not by much, but CAC Carol by 0.72 and the DAX by 0.23. TSX yesterday. It finished down by a half point, but still well above 34,000. It's actually above the high from March. So it was an off day, a little taking back. Who were some of the movers and shakers yesterday? Let's take a look. Terabest up by 7.67, Superior Plus 6.67, going the other way. America's Gold and Silver 3.68 was down, and the Boyd Group off by 4.35. Taking a look at the metals, and everything is off today. Gold down below 4,500, off by 1.3% roughly. Silver futures off by more than 2, down below 75, and copper's down by 0.22 to 638. Western Canadian Select, no surprise, on the news out of Iran, started to drop, down by 3.38% to 75.58. In WTI today, it's off by 4.5% now, well below $90 a barrel. We'll see what happens. Up next, Colin Stewart will stick around to see why Brookfield Renewable is on his radar. All right, time to see what's on the radar for Colin Stewart, CEO and Portfolio Manager at J.C. Clark Limited. And showing up right now, Brookfield Renewable Partners. What has your interest there?
Yeah, I mean, we've owned Brookfield Renewable for quite a while. They're one of the leading, I mean, not just Canadian, but global renewable companies. They've got a broad portfolio of hydroelectric assets, solar, wind, energy storage, battery storage, which is becoming an increasingly important part of their business. And, like many other of these sort of AI peripheral businesses, I would say they're really seeing a benefit because as we've all read, there's a huge increase in the demand for electricity and power, and driven by the sort of huge power consumption of these AI data centers, which is leading to a supply deficit. And that is ultimately creating a situation where renewable companies like Brookfield have strong pricing power and are able to actually enter into, if anything, becoming better businesses because they're entering into these long-term PPA agreements with leading tech companies who are willing to pay higher prices to sort of secure.
Just to guarantee they've got
to
something.
guarantee. And I mean, I think it was one of the first ones they did a number of months back was with Microsoft. It was like a 10-year plus deal where they locked in at very good pricing. And so, and I think the other thing is a lot of these tech companies do the idea of using more renewables to power their data centers.
It felt like it got lost a little for a while, renewables and green, especially green at like the windmills and things like that. But is it coming? Coming back? Are people starting to turn to it again?
It is a bit, and I mean I think it's just coming back because there's just so much demand for power.
Yeah.
And a lot of this tech ecosystem, I think there's a concern that there's criticism if they're using too much power for the data centers and it's not clean power. That they don't like the PR around that. So there is I think an increasing need for both reliable power and using renewable power. And Brookfield is perfectly positioned to do that because they've got significant access to capital, have been in the renewable business for a long time. I think they're very well positioned to strike more of these type of long-term power purchase agreements with the tech companies like a Microsoft that I mentioned. And beyond that, I mean, one of the things we've seen as an investor is if you want to play the AI theme directly, you often have to pay a very high price to buy a tech stock in the US. But the nice thing is Brookfield Renewable is a very profitable business, generates great cash flow, pays a 4.5% dividend yield, and only trades at about 14 times EBITDA. So it's something as we're sort of more value-oriented investors, you can get your head around. It's a good business, generates cash flow, been around for a long time. It's not some upstart that is losing money. So I think for a Canadian investor as a way to buy a reliable business that has, really good supply-demand dynamics over the next decade and trades at a reasonable multiple, it's a good one.
All right, and I love this next one because it's just something you probably wouldn't think of. Black Diamond. Modular space solutions and workforce accommodations.
Yeah, so it's they've got sort of two businesses, and the I'll get to the second one, the workforce business, in a second. It's sort of the old camps business where they did set up camps for these oil sands companies, and it hasn't been doing super well recently because the big oil sands projects have not been a focus for the last while. But this modular space solution, I mean, just think of it as, if you drive down the street and there's someone's building a bridge or fixing a road, there's often a trailer on the side of the road, and the construction company is renting that trailer from someone like Black Diamond, and they get a rental rate. So it's a very reliable cash flow producing business. And this is a North American business. They have these trailers all over the place on construction sites, infrastructure projects. They even provide portables for the education sector in the U.S., which is a growing area because there's a sort of shortage of new room for schools to expand. So they often have these portables on site, and they get a very stable rental rate. They're able to raise pricing. So it's been a very good business. And now, as we're thinking of data centers being built, these massive construction projects, they need offices, meeting places for workers, washrooms, things like that. And Black Diamond is in the business of providing that. So they're actually getting a tailwind from the data center side of the business as well. And then if we go to the workforce side, where that old oil sands camp business has been, running at a very low capacity utilization. Only about 50% of their assets have been utilized. But now what's happening because of this huge infrastructure push in Canada, development of the north, Arctic development, resource
increasing
projects.
Oil production.
Yeah, increasing resource production. These camps are starting to be needed, these camp assets, and they're sort of, again, modular. They can move these accommodations around. They actually bought a business recently that does catering as well, so they can offer that. And just think as these, new military bases get built, new mines get developed, LNG facilities, this massive theme around the development of Canada's north is really going to benefit this business because these workers, and even their data centers getting built in some of these more remote regions, and the workers are going to need a place to stay. And all that being said, Black Diamond's a really well-run business, solid management, and only trades at an 8 times multiple of cash flow. So we think the outlook is very bright.
All right, let's get the last one in here. Exchange Income Corporation.
Yeah, this is again a company that's been around out of Winnipeg for a long time. It's sort of a bit of a diversified industrial company, but 85% of their business is really in one division that's called aviation and aerospace, and it does 2 key things. One is that they've got the dominant sort of almost monopolistic type of position in an airline to the north in Canada. So they do passenger airline to the north, freight, charter, and obviously with the development of the north, you'll have a lot more people going up there. So that's very positive for them. And then they've got another business that is called in the ISR business. It's basically intelligence, surveillance, and reconnaissance. So for different countries wanting to monitor their borders, their marine borders, land borders.
Our north.
Our north, exactly. Exchange income is perfectly positioned around that. Pays us a great dividend, which has increased, I think 25 times over the last 20 years. Well run, and all that being said, it's sort of a way to get exposure to the aerospace and defense sector. But again, it only trades at about 9 times EBITDA, so it's not a demanding multiple, and it's a nice way to sort of for Canadian investors to back into this defense aerospace theme at a reasonable price.
And even with the surge it's seen over the last year, and it's
the multiple is still cheap compared to U.S. defense companies trade at 15, 16, 17 times EBITDA, and I think the huge spend we're seeing here in Canada to bring the targets up on defense spending as a percent of GDP is really going to benefit the whole sector in Canada. And I think exchange income is one of the cheaper ways to play that theme.
Okay. Still going to move ahead now. We're going to talk about how to play the AI boom, one that's closer to home, potentially much cheaper, not a bad thing. We'll discuss it after the break. And of course, our phone lines will open soon for our first call segment. You can reach us at 1-855-326-6266. Send us an email, firstcall@bellmedia.ca. Bank of Montreal top profit estimates in the second quarter on robust fee revenue across capital markets and wealth management. Global markets and corporate banking were also up significantly from a year earlier. The bank increased its quarterly dividend by 4 cents a share. BMO's provisions for loan losses were lower than expected. Lululemon says it has reached an agreement to end its feud with founder and largest individual shareholder Chip Wilson. The company agrees to appoint 2 of Wilson's nominees to the board. A product and brand expert will also be appointed. In exchange, Wilson agrees not to criticize the company in private or public for 18 months. Target is aiming to improve workers' customer service skills. Employees will be tested on how they greet, help, and engage with shoppers in an effort to make service more consistent across stores. Elevating store experiences is one of Target's top priorities. So far, 300,000 employees have completed training to make stores easier to shop and service friendlier. The company hopes to turn around years of sliding sales. And a quick look at the U.S. futures. It's continuing to surge, looking for another week of ups. And right now, it looks like we might see that. The NASDAQ 100 up by 0.83, the S&P 500 by 0.3. Okay, so many investors are chasing U.S. tech giants, all tied to AI, but there are many Canadian companies that are quietly positioning to benefit from the massive spending on data centers and infrastructure. Let's bring in Colin Stewart from J.C. Clark Limited to discuss where he sees those opportunities. We're kind of talking a little bit about it really before the break, but you have to look at it as it is a bigger picture in many ways, isn't it? If you don't want to get caught up in those key groups, the Mag 7 and things like that.
Yeah, I mean, I think what's happened in the market overall is the most obvious beneficiaries of AI, the hyperscalers, the companies building these frontier AI models like Google and, some of the private companies, OpenAI and Anthropic, are obvious. And so they receive a very high valuation that gets priced in very quickly. There are a lot of hardware companies, semiconductor space in particular has been very hot recently in the US and, companies trading at, again, high multiples in some cases. So I think in Canada, because some of these second and third derivative plays are less obvious, we've sort of thought about it as almost a picks and shovels approach. So, same in mining, instead of owning the mining company, own the company that does the picks and shovels and builds some of the infrastructure for it. And I think, Canada is very well positioned in that respect. We think about what Canada has, and we've got ample land, cheap electricity, skilled workforce, abundant natural resources, and a lot of these things, it's cheaper to build a data center when you've got
stability as well.
Yeah, low cost land and a lot of renewable electricity, cheap electricity, so I think some of the businesses in Canada are really well positioned to benefit from this huge capex build out. The build out of data centers, and I mentioned a couple of them earlier, Brookfield Renewable on the energy side. I think Black Diamond benefiting on the the sort of infrastructure build out around some of these data centers. But even thinking down the chain more, you can think about, the copper intensity in a data center is just massive compared to even a regular data center for an AI data center. So the amount of copper that's required to sort of power, the wiring for these data centers is going to be massive. So you've seen, copper prices hitting new highs recently, and there are a lot of companies. One we own is Capstone here in Canada, and so there are a lot of companies on the copper side that are simply going to benefit from, demand for their product and copper prices moving higher. So. And I think another example would be a company called Enerflex that we own in one of our funds, and it's a compressed natural gas player, and that's again an area you're getting a lot of this. They call it behind the meter powering for data centers, where these data centers can't easily connect to the grid and drive up power prices for all the neighborhoods around them. So they need to create their own power source on site, and there are a lot of again Canadian companies that I think are well positioned to sort of participate in that. And the nice thing is, because they're less obvious, the stocks maybe have not had the huge run, and the valuation multiples are more reasonable, so you're not having to pay 50 times earnings.
Any concerns with blowback on the data centers? I mean, there's been a little, you hear it down in the States, and they've seen a few that have been rejected or they're fighting them. Any concerns about that up here when it comes to the data centers?
Yeah, I mean, I think so for sure, but I think that's driving some of these trends. I mean, this whole NIMBY thing, not in my backyard. I mean, it's understandable. I mean, I don't think any of us would want a data center right next door to the neighborhood you live in, where your kids go to school. So. But again, I think Canada, because it's got a lot of land, is well positioned there, and this has driven this, I think, push for this behind the meter power. So a lot of the companies in Canada, Enerflex I mentioned, even Superior Plus, which stock has been moving up because they have a CNG business as well. Those businesses, I think, are well suited to provide sort of on-site generation for these data centers that is not on the grid. And the idea is that hopefully that will prevent the power prices and electricity prices for the people who live in those areas from going up. And I think that is, one of the concerns that people have.
What about nuclear? Do you see opportunities there?
Yeah, I mean, I think nuclear is part of that sort of value.
I mean, they talked about it a lot, to the modulars, the small modular reactors to power those centers, but that's a 10-year.
It is, and I mean, I think, again, speaking of companies in Canada, I mean, Canada's had nuclear for a long time, and I think Brookfield Renewable is positioned on the nuclear side, and then you've got a company like, Cameco, which is obviously mining uranium, which is the key input for nuclear. So I think, again, Canada gets a bit overlooked in this AI trade, but it's increasingly, as people sort of go down the chain, and the most obvious stocks are already well priced for the upside and the long-term benefit, people are saying, well, hold on a second, there's this company in Canada no one's been talking about, and they actually are, Black Diamond. I mean, who would think a company that has these modular spaces is actually starting to benefit from the build out of data centers or renewable power? So I think there are a lot of less obvious candidates in Canada, and the market is now starting to pick up on those and recognize those, and we're seeing the share prices improve. But the nice thing is the valuation multiples are low, they're profitable businesses, in many cases they pay dividends, and they're just getting sort of a nice tailwind around their core business. And nuclear definitely is another area in Canada that I think will benefit from this.
All right, we're going to take a break on that note there. Still ahead, though, a massive surge in defense spending could be a game changer for Canadian companies. And of course, our phone lines are open. Colin Stewart is taking your questions on North American stocks. Call us at 1-855-326-6266. Email is firstcall@bellmedia.ca. Canada and its allies are ramping up defense budgets in a big way, with plans to increase spending and add tens of billions over the next few years. And with more contracts expected to stay at home and new domestic supply chains emerging, a wide range of Canadian industries stand to benefit. For more on this, we're back with Colin Stewart, CEO and Portfolio Manager at J.C. Clark. And we were just talking about it off air. It'll be interesting to see how much of that money is actually new money, as opposed to kind of a little bit of creative accounting, and things like raises for soldiers, which were long overdue, or military personnel long overdue. But you think there is money in there, don't you?
Yeah, I mean, I do get the sense just from hearing politicians speak, and I was at a very interesting CIBC conference last week on sort of defense and resiliency in Canada. And I mean, I go to a lot of investment conferences. I don't think I've seen one that large in the last decade. I mean, there were 800 plus people there.
Wow.
It was, industry people, investors. So there definitely is a lot of excitement around the sector. And I mean, if you just think about the sheer magnitude of the numbers going from less than 2% of GDP to over 5% of GDP in the next, decade or less. And even in the next 5 years, they're talking about $84 billion in incremental funding. And I mean, that's going to drive growth in a lot of the NATO countries. We're not just seeing this from Canada, but I think the fact that Canada and Mark Carney are trying to align ourselves more with these NATO partners, there are going to be contracts that potentially come to Canadian companies from some of those other NATO countries. We've already seen some of that, and I think it is real. And the other important thing is that the Canadian government is really trying to focus on increasing the Canadian procurement. In other words, that spend has historically gone to a lot of businesses outside of Canada. I think only 40% or maybe even slightly less has historically been with of the defense spending has gone to Canadian businesses, and they're targeting now 70%. So not only do you have a huge increase in the top line spending, but you've got I think a big improvement in the procurement for Canadian businesses, and I think that's going to lead to a lot of growth in the established companies here.
I was going to say, do you see that money going to established companies, or do you see upstarts and new companies?
Well, I think both, and I think there's probably a risk that if there's a bit of a gold rush on, where I think there are a lot of new upstart companies who are trying to get contracts or say we've can do some of these things, and I don't think it's necessarily around, as I mentioned earlier, building fighter jets or submarines. Canada has
some
to go
things
outside
we just realistically can't do
for those large military platforms. But I think when it comes to things like sensors and drones, you're certainly seeing some excitement around those sectors. But we're more on the side of it's more likely that the large dollars are going to go to established companies in Canada. I mean, some examples, obviously, like, Bombardier has a defense business. It's not the biggest part. We own a company called Magellan that has been around for a long time.
The GPS, Magellan GPS?
No, the symbol's MAL. It's Toronto-based, but it's got facilities across North America and Europe, and they've got about 60% of their business on the commercial side, where they produce parts for Boeing and Airbus. They've got a 40% of their business is military, where they're producing parts and parts for the body of the airplane and the cockpit and things like that for the U.S. military, the Canadian military, a number of countries in Europe. So I think, they're more established. It's like $1 billion plus company. And I think it's businesses who have, proven track record, facilities that know how to do it, who are more likely to win the larger contracts. And, I think there aren't a huge swath of public companies in Canada. I mean, one I mentioned earlier, Exchange Income, I think they fit in that bill, and I think are poised to win some of these, military surveillance contracts from different countries, potentially from Canada. And we think it's real, and it's a pretty exciting period. And again, a lot of the public Canadian companies still trade at a pretty low multiple compared to the U.S. ones, because obviously Canada has underspent on military for a long time, and I think that's about to change.
Are you looking at smaller companies at all, or are you staying away from them?
No, we are looking at a few of them. I mean, there's some interesting smaller businesses. One that sort of has a drone business. One that we're just starting to look at called Maritime Launch. They've got the the launch pad in Nova Scotia for potentially putting satellites into orbit. But so there are some of these upstart space. I mean, a company MDA, I think people are familiar with, is more on the space side, but there's our defense applications there too. So I think there are some exciting things happening in Canada, and we I think the key for investors is this is in our view not just an overnight or a 1 year thing. I think this is really a 5 or a 10-year trend that investors can kind of bank on. Is going to, you're going to see increased government spending both from the Canadian government on defense, but from other NATO allies. And I think there are certainly a number of opportunities to invest in Canadian companies that will benefit from this.
Okay, got to take a break on that note there, but still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including a downgrade on First Capital REIT. Let's take a look at some of the notable analyst calls and recommendations. RBC Capital Markets analyst Pammy Beer has cut the recommendation on First Capital Real Estate Investment Trust to sector perform from outperform. PT set to 24.40 Canadian, implying a 3.7% increase from last price. National Bank Financial analyst Cameron Dirksen cut the recommendation on Transat Inc. to Class Bs to underperform from sector perform. PT set to 225 Canadian, implying a 17% decrease from last price. RBC Capital upgrading New Farm to outperform from sector perform with a price target of A360 up from A340. The revised capital efficiency focus on margins over volumes, cost reduction program, and lower CapEx outlook should provide a solid near-term trajectory of improved returns under normal seasonal and market conditions, the analyst tells investors in a research note. William Blair downgrading Vero Mobility to market perform from outperform without a price target. The loss of rental car tolling customer Avis is a major blow, the report says. And Hovde Group analyst David Bishop downgrades ACMB from outperform to market perform, raising the price target from $56 to $57. Well, New York's plan to offer discounted World Cup tickets is raising expectations in other host cities. Vancouver holds about 9,000 tickets, most purchased by the city, with no freebies for officials or staff. The key question is, how will these tickets be distributed to the public? CTV's Andrew Johnson has more.
A World Cup win for New York City's mayor.
These 1,000 tickets are going to be split into batches of 150 tickets for each of the 5 group stage matches and 2 knockout round matches in New York, New Jersey, and tickets will cost only $50.
New Yorkers priced out of the World Cup have a shot every day this week at $50 tickets in a daily lottery.
If I win, I'll be there.
Mayor Zoran Mamdani negotiated the approval to sell discount tickets to the public with FIFA President Gianni Infantino. That got us thinking about Canada's 2 host cities and why affordable tickets are not being offered to the public here. We asked the Vancouver Host Committee about that. Here's what we learned. The municipality is in possession of 9,000 match tickets across Vancouver's 7 games. Of those, 1,600 were provided to the city by FIFA and 7,400 were purchased by the city. The host committee says the majority will be sold off through its sponsorship program to help offset hosting costs. This urban planning specialist doesn't like the look of those optics.
So purchased with taxpayer funds, but we don't know how much they're actually going to charge, right? I don't even know if we know how much they paid for the tickets. And to do so in a way that is transparent and honestly just fair.
When we asked how much the tickets are being sold for, we were told in an email that's confidential.
So this is not the way government is supposed to work.
Vancouver says it is providing up to 350 tickets for young people who face barriers. Toronto's host committee is expected to provide ticket data tomorrow. Andrew Johnson, CTV News, Vancouver.
When we come back, Colin Stewart takes your questions on First Call. All right, time for First Call and first email, and that is from Len. REITs seem to be having a positive turnaround. What is your outlook for top-tier Allied over the next year or two as they repair their balance? And we just had, so I'm just blanking on First Capital was just downgraded by sector perform, right? So yeah. Are they turning it around?
Yeah, I mean, we don't own Allied. It's a office REIT in Canada. It's been around for a long time. They tend to maybe not own some of the big, towers. They own some of the more, King West, think of like the loft type spaces, and that's been a focus, and that had been great for a long time. And then, as with all the office REITs, when COVID hit, that really dramatically changed the business due to work from home. Allied cut their dividend not that long ago, so that sort of put more pressure on the stock, as we can see. I think it was back in February, March timeframe. And that was probably the right decision because they need to, repair their balance sheet and focus on debt repayment. A lot of these REITs are levered, but I think the overall trends in the office space are certainly improving. We don't have investments there right now. We do own some other REITs, but we are, looking at it. I think office has been very out of favor, but you are seeing people come back to work and downtown getting busier, and some of these REITs trying to sell off non-core properties, focus on their best properties, and that's really what's happened. There's been a real bifurcation in office. Someone like Brookfield that owns the very highest quality towers in Toronto and New York are doing quite well. Those occupancy rates are very high, but if it's anything sort of outside of the core, those B or C buildings are running still at 50-60% occupancy. So so that's one to watch, but not one that we own right now at JC Clark.
Okay, this next email is from Amesh. What is your guest's opinion on GE Aerospace? Is this a good entry point for a 3 to 5 year hold?
Yeah, I mean, I think as I talked about earlier, we like the whole defense aerospace sector. I mean, GE's got a big business on the engine side, providing engines to the likes of Boeing and Airbus. So I think that's well positioned to do some military business as well. And I think, overall, this sector, I mean, the stock's done well. It's not, last I looked, we don't own it. It's not overly cheap, but it's not surprising. I just think this aerospace defense theme is very powerful. It's not only are you seeing big promises in the U.S. from Trump about increasing military spending, but now
500 trillion, right?
Yes, and now due to the pressure he's put on NATO countries, you're seeing a huge scramble for many of these NATO companies realizing, well, we can't maybe rely on the security blanket from the U.S. We need to build up our own militaries and increase that NATO target up to that 5% level. And I think that's going to, that and the continuation of global growth in air travel on the commercial side, which we're seeing in developing countries in particular, continued, cheaper to fly. People want to travel. People enter the middle class. They spend more money on airline tickets. And I think all those trends are very good for GE Aerospace. So I think it's probably a pretty good one to own as part of an overall portfolio basket on that theme.
All right, let's get in one last one from Anna. What are your guest thoughts on GFL? We've got about 30 seconds.
Yeah, it's we don't own it, but it's a well-known waste management company here in Canada. I think it's been, a decent long-term business. Interestingly, the waste sector, which had been pretty hot for a long time, and it's not only GFL, but I think a lot of these stocks have been somewhat out of favor and under pressure. But I think overall, if you have infrastructure spending, population growth, more construction, those types of trends are good for a business like GFL. And I think the last I saw, the multiple or the valuation multiple it traded at among some of the other large waste management companies have come down. So perhaps for a value play, it's a good time to look at it.
All right, perfect. We've got to wrap it up there. But Colin, thank you as always for joining us.
Thanks, Roger.
All right, that's it for us here on The Street. Thanks again to Colin Stewart, CEO and Portfolio Manager at JC Clark, joining us today. Lindsay's up next with The Open. Trading gets underway in about 30 minutes from now.